Okay, hello everyone and welcome to the Next Gen Manufacturing webinar series, proudly hosted by RSM Australia and the Advanced Manufacturing Growth Centre. The series comprises 3 different events, and the first one today is all about accessing capital. My name is Michael Sharp and I'm the National Director for Industry at the Advanced Manufacturing Growth Centre. AMGC is an Australian government initiative to help transform the manufacturing sector. Actually, we say it's more than just an industry sector. Manufacturing is a nation's capability. What are we capable of producing? What are we capable of making and sending to the world? Export is so important to manufacturing and we need to do more of it. I would encourage all of you to have a look at our latest platform, which is the Manufacturing Academy. It's Australia's first manufacturing academy, and if you Google that, you'll see a great range of Australian business leaders from companies big and small, sharing their experience about what it means to be an advanced manufacturer in Australia today. A couple of housekeeping things before we kick off. Your microphones will be kept on mute, so please submit any questions that you have through the Q&A box at the bottom of the screen. And I'm happy to take questions throughout the next hour and pass them to our panellists as we go. A recorded version of this webinar will be made available after today's session, and you'll receive the link to that. We've got a great mix of speakers today, and they'll provide you with insight into the current landscape of capital and debt markets, the types of funding that's available, and the experiences of a great Australian manufacturing success story. I'm so glad that Gary Beard can join us. Firstly, I'm honoured to introduce the Minister for Finance. Senator the Honourable Matthias Cormann has made time to join us today and provide an overview of the federal government's $1.5 billion boost to the manufacturing sector and the government's vision for manufacturing in Australia. So, Senator, it's over to you.
Thank you very much, Michael, for that introduction, and good afternoon all. Thank you to RSM for hosting this session. Normally, the week after the budget is delivered, I would be crisscrossing the country and would be making these sorts of remarks in person. So I'm sorry about not being able to do that this time around. But I guess during these COVID times, we're all getting used to making and receiving messages like this by video. 2020 has certainly been an extraordinary year on the economic front, responding to the impact of the pandemic in Australia. Our mission has been in the first instance to cushion the blow on business and on jobs. We put in place historically unprecedented fiscal support measures like JobKeeper, the cash flow support measures, the doubling of income support for those Australians who lost their job, and so on. But now it's very much a matter of transitioning into the strongest possible economic and jobs recovery from here. And so last week we delivered our 2020-21 budget. That budget is our plan to get Australia out of this COVID recession. It's our plan to maximize the strength of the economic and jobs recovery moving forward. And our focus in this budget is very much on facilitating a private sector-led economic and jobs recovery. We want to continue to save as many jobs as possible, to restore as many jobs as possible, to facilitate the creation of as many jobs, the new jobs as possible moving forward. And in that context, we understand, of course, that jobs don't grow on trees. Jobs are created by viable, successful, profitable businesses in sectors right across the economy, and including and in particular, of course, the manufacturing sector. Now, if we want more jobs created across the economy, what we are seeking to achieve and what we need to achieve is to ensure that businesses have the confidence to invest in their future growth and success, which is, of course, why in this budget, most of the fiscal support is aimed at giving businesses that confidence to invest in their future growth and success. Because in the end, it's only genuinely viable, profitable, growing businesses which will hire more Australians. In most parts of Australia, as the virus has come under control and containment measures have been eased, the jobs that had been lost have in fact started to come back. Of about 1.3 million people who lost their job or who were stood down on 0 hours for economic reasons in April, almost 60% or 760,000 jobs have now come back. So the government is now very much focusing on transitioning to ensure the Australian economy recovers as strongly as possible. Which is why, we're doing this, just by way of broader context, by targeting additional temporary support measures to boost household incomes and therefore boost aggregate demand in the economy, and also by bringing forward business and infrastructure investment activity. That's why in this budget we announced a number of new initiatives to support new investment and boost business cash flow through this period. For example, we announced the temporary full expensing incentive to encourage new business investment. It will be available to around 3.5 million businesses employing around 11.5 million workers. We expect that this temporary full expensing incentive will apply to around $200 billion worth of investment, including 80% of investment in depreciable assets by non-mining businesses. Businesses with a turnover of up to $5 billion will also be able to deduct the full cost of eligible depreciable assets of any value in the year they are installed. The cost of improvements to existing eligible depreciable assets made during this period can also be fully deducted. And furthermore, the government will also allow companies with turnovers of up to $5 billion to offset losses against previous profits on which tax has been paid to generate a refund. The carryback of losses will be available to around 1 million companies which employ up to 9 million workers. So losses, under this measure, losses incurred up to 2021-22, that is to 30 June 22, can be carried back against profits made in or after 2018-19. Eligible companies may elect to receive a tax refund when they lodge their 2020-21 and 21-22 tax returns. In relation, importantly for our manufacturing sector, we've also decided to invest a further $2 billion into improvements to the operation of the research and development tax incentive. Now, for small claimants, those with a turnover of less than $20 million, the government will increase the refundable R&D tax offset to 18.5% above any claimant's company tax rate. And there will be no $4 million cap on annual cash refunds. For larger claimants, the government will streamline the intensity test from 3 to 2 tiers and increase the non-refundable R&D tax offset rates. The new rates will be the claimant's company tax rate plus 8.5% for initial R&D expenditure, up to 2% R&D intensity, and 16.5% for R&D expenditure above the 2% R&D intensity. The government will also proceed with the increase in the cap on eligible R&D expenditure from $100 million to $150 million per annum. These changes will apply from 1 July 2021, and they will support more than 11,400 companies who claim the R&D tax incentives. Another key part of our job maker plan, and as Michael just mentioned, is our $1.5 billion modern manufacturing strategy. Clearly, we want our manufacturing sector to play a key role in our economic recovery moving forward. Manufacturing is already a significant part of our economy, of course, employing over 860,000 people. It has also been critical to our COVID-19 response, with many manufacturing businesses retooling to deliver the essential products we needed for our effective response to this crisis. Our modern manufacturing strategy is designed to help deliver high-value jobs, improve our competitiveness, and ensure we have access to the essential products needed to keep us secure and resilient moving forward. It prioritizes industries that match our areas of comparative strength or areas of strategic interest, where Australia has the capability to compete with the rest of the world. This is about Australia playing to its strengths and the government strategically investing in areas of manufacturing where we know we have an edge and we can deliver the jobs growth that we want to secure. The centerpiece of the strategy is the $1.3 billion modern manufacturing initiative, which will see the government strategically invest in projects which help manufacturers to scale up and create jobs. It will support projects within 6 national manufacturing priorities, which reflect Australia's established competitive advantages or emerging areas of priority. Those areas are the resources, technology, and critical minerals processing area, food and beverage, medical products, recycling and clean energy, defense and space. This initiative aims to drive lasting change for Australian manufacturers. It will help Australian manufacturers to scale up, as I've mentioned, collaborate and commercialize. It is designed to unlock private sector investment and to support manufacturers to deliver on the world stage. The COVID-19 crisis has also highlighted the need to better understand and address our supply chain challenges and opportunities, which is why we have announced a specific $107.2 million supply chain resilience initiative, which is designed to support projects that address an identified supply chain vulnerability. This is about incentivizing industry to take advantage of opportunities to provide both domestic and global supply chains with critical products. Our government will work with industry to build a comprehensive understanding of those critical supply chains, to identify the essential goods and services critical to Australians at times of crisis, to map industry supply chains and Australia's manufacturing capabilities, and to evaluate supply chain resilience under normal circumstances and in possible crisis situations. We will work with industry to identify supply options to address vulnerabilities in domestic and international supply chains for identified critical products. Another element of our modern manufacturing strategy is the $52.8 million commitment to the second round of the Manufacturing Modernization Fund, which co-funds capital investments which help manufacturers again scale up, invest in new technologies, create and maintain jobs, and upskill their workers. This second round builds on the very popular and successful first round of the program, and it will help support approximately 150 firms which align with the national manufacturing priorities. It will also fast-track capital investment in manufacturing. It will help businesses take on new employees, upskill their workers, and invest in new technology to support our COVID-19 recovery. Finally, a very important further part of our manufacturing strategy is our commitment to provide an additional $30 million in project funding to the Advanced Manufacturing Growth Centre. The Advanced Manufacturing Growth Centre will work with other industry growth centres to support advanced manufacturers, particularly small and medium-sized enterprise, to upscale their businesses. Since its creation, the Advanced Manufacturing Growth Centre's support of advanced manufacturing projects has already directly created more than 2,300 jobs and supported more than 8,000 indirect jobs beyond that. The $1.1 billion in economic activity from the 78 projects I have backed so far will be amplified through the provision of this additional project funding, which is ready to be rolled out and hit the ground immediately. I might just leave it there. I hope that that was a helpful snapshot of what the government is focused on doing in this sector of the economy as we continue to build our path to the strongest possible recovery. Our budget is our plan to get Australia out of this current COVID recession. It's our plan to maximize the strength of the recovery. And it's about rebuilding economic resilience as we keep developing a more competitive growing economy. So thank you so much for the opportunity to share my thoughts with you today, and all the best for the remainder of your webinar today moving forward.
Thank you, Minister. I'm so glad you could join us. It's certainly been a big year for everyone, and thank you for your service during this crisis. It's been a busy time for everyone. And the good news, as you know, is that everyone is suddenly talking about manufacturing. So we certainly look
indeed. Thank you very much.
Okay, all the best. Thank you. I would now like to introduce our panel speakers. Today we've got Nathan von Brock, who is the Senior Manager in Corporate Finance at RSM in Sydney. Welcome, Nathan.
Hi, Michael.
Glad you could join us, mate.
Thank you for having me.
11 years experience, including 8 years in corporate finance. He has experience across a range of industries and transaction structures, and is also, you'll have to tell me what this is, a CAA New Zealand Registered Business Valuation Specialist. That's a big one, Nathan. You can tell us a bit more about that. Nathan specialises in providing M&A capital raising, and due diligence services. So thanks for that, Nathan. We'll get stuck into it. I'd like to introduce our second panel speaker, who's Gary Beard. Gary is the chairman and director of Beard, a great Australian success story in manufacturing. Gary's been involved in the business for over 40 years. And over this time, he's seen the family-owned business grow from $3 million turnover, employing 32 people in one factory at Sanssouci in New South Wales, to now $140 million turnover, employing over 430 people across 7 factories in Australia and New Zealand. And they produce up to 10,000 mattresses each week, exporting to China, South Korea, Thailand, and Papua New Guinea. Welcome, Gary.
Thank you, Michael. Yes, thank you, RSM, for supporting this hookup that we got.
It sure has been a busy year, Gary. I know you and I have been working closely on a few projects, and during the early weeks of the crisis, we had an emergency hospital bed project going where you were able to produce mattresses for that need, which was just terrific.
It really did show the strength of manufacturing, where we had another guy around the corner who made the metal frame that was needed to meet an international standard. And it all came together in 7 days, ready to supply anything up to 10,000 beds. Luckily for Australia, that didn't happen, but amazing when you have to mobilise things that it can be done.
Yeah, and I think it shows the strength of Australian manufacturing that in a time of need, when we needed to build those local supply chains, I know in the first call, we were within 3 hours, we had those supply chains coming together, and that was just a great success story. So that wasn't the first time that Beard has been able to stand up for the country, though. I know your father and grandfather have done similar things in times of national crisis. So it's, we'll learn more about the family business today, I'm sure. But I think the other thing I'd like to raise is our latest report from AMGC, which is the 10 ways to succeed in Australian manufacturing. We've just published this, and it's our latest research from across Australian manufacturing, companies big and small, that we've been able to engage with to find out the current state of play and where you find your business is today. And so one of the points on one of the ways to succeed in Australian manufacturing is better and improved access to capital. And so hence what we're talking about today. And Nathan, I think I'll throw the first question to you, but I'll remind everyone that we're happy to take any questions throughout. So the Q&A button at the bottom of your screen, just click on that and fire any questions to us, and we'll do our best to get through them. But Nathan, would you mind providing an overview of the current equity and debt capital market landscape here in Australia?
Yeah, thanks, Michael. I was kind of thinking about this morning and how I could best answer this. And I was thinking maybe to link the sentiment to kind of what the All Ordinaries has done in a little bit. And if you look at the All Ordinaries back in kind of late February, we were at about 7,250, which was close to a record, quite up there. And you know, the equity and debt markets then were pretty good. Money was available. And then within a couple of weeks, the All Ordinaries dipped down to 4,500, somewhere around there in mid to late March, I think around the 23rd of March. And everyone's wallets shut pretty quickly. And capital was kind of not available. Everyone went internal, I think, and was looking at their own business and what do they need to do to survive. And it was a very negative kind of sentiment at that time. And you know, fast forward now, and I think this morning, the All Ordinaries was about 6,400 or so, which is kind of 88% of pre-COVID levels. And I think that's reflective of people's sentiment at the moment too. I think people have got over that initial shock and uncertainty of what is this virus and how are we going to survive, and you know, what do we do next, and things can change literally tomorrow or in the next couple of hours. And now people are certainly thinking, you know, what next? How do we grow? What can we do? How do we move forward? And the virus is, you know, whilst it's still there, it's certainly not front and center for people's thinking. And I think you can see that in debt and equity too. Banks are certainly open for business. They're, you know, in some banks are aggressively chasing new business. And I think you'll find that the due diligence process will probably be longer and it will be more robust and more involved. But they're aggressively trying to chase business and get money out there. There was some government support to that end too. And equity investment is very similar. We catch up with private equity funds regularly. They're still looking for deals. They're looking to invest money. They've got a lot of money sitting there that needs a home. And they did the same thing. They went very insular and looked at their own portfolio for a couple of months now, but that's very much changed, and they're looking for new opportunities. Speaking to colleagues in the US, the UK and New Zealand over the last week or so, they echo those sentiments. Their UK and US especially are at different stages with the virus compared to us. But speaking to a colleague in New York last week who looks after US private equity deals, and he said September was the busiest month they've ever had. So, there's still plenty going on in the market. I think it was the uncertainty there, and now that we've passed that kind of uncertainty stage, albeit travel and things like that are still very much in it, the majority is past that uncertainty stage. I think things are certainly looking quite positive.
Yeah. And Gary, as I said, this isn't the first time that AH Beard has had to come through a crisis. The business has been going for over 112 years now?
120. We celebrated 120 last year.
Yep. 120 years, and that's 5 generations we're up to now?
4th with the 5th working here now, yeah.
There you go. So the 5th generation coming into the business. That's quite a remarkable feat. One of the things we found in our 10 Ways report and talking about access to capital is around preparing or updating your business plan. And Nathan talked about reaching out to the banks and that sort of thing, but it's important to have a plan. And so I imagine that the business planning over the years has had to change. And you might tell us a bit about your grandfather's opportunity coming through and serving during the war and the needs that happened there.
Yeah, I suppose really, mate, I was going back to the first guy came out from Birmingham. He was a candlestick maker and boot maker, but he decided to set himself up to provide cutlery, crockery, and table and chairs and a bed for all the immigrants coming out at the time. So he was the one that kicked it off. His son, Albert, my grandfather, had the opportunity on a bet to make 7 beds in a week. So he was an upholsterer by trade. So he used the half-gold sovereign that Dad had provided to get finance from the bank back in those days to buy ticking and the stuff you put inside the bed. And grandmother sewed the cover and pop-filled it and stitched it up to look like a bed. And then Dad came along after doing his time in the Second World War, got very active into the commercial world, and names of Koala and Travel Lodge and all those sort of things where back in those I remember where Dad would sell the actual invoice for the size of the contract and get finance accordingly. And moving on from there, our relationship with ANZ as a manufacturer has been absolutely fantastic. They have helped us grow through acquisitions of 3 other family businesses across Australia, and understanding. They do understand our business. They understand manufacturing. They understand partnerships and retail partnerships. So yes, the world is changing again, and that hopefully, and what I'm hearing so far, that what we did back in the level playing field of going offshore, that we can bring it back on shore and start employing more Aussies.
Yeah. There's certainly a lot of people looking to reshore their manufacturing back to Australia, which is an opportunity for everyone. I think that's great, new jobs and all the rest that comes with it. But as far as, for the others out there listening, the importance of having a business plan must be vital to show the bank about where the business is up to, because another comment we have in the report is that a manufacturer from South Australia, he says that the bank is not set up to help manufacturers as they do not understand the business and they don't know what we need. So we need to talk to our bank. So that's pretty important, don't you think?
Very
planning
much so.
side. And so the more you can put a plan together is vital to growing the business, so that outside funding arrangements can be backed up. And so Nathan, that brings me to another question for you, which is regarding debt funding. What are the differences between, or the benefits of, the traditional banks, which is what we're talking about, or the newer neo-banks and their second-tier lenders? What types of products are typically available from those?
Yeah, so I think your big banks are, as you'd expect, they're very big beasts these days. Well, they've been for quite a while, and they're very rigid and structured and things like that. Your neobanks and your second tier lenders are a lot more flexible, nimble, and have a different range of products, I think. So, you will generally get probably the best rate with your big banks because of just their size primarily. But, you have to have probably a more solid business, or you have to have a good history behind you, or you have to have good security that you can offer up to protect their position. And people like the neobanks that are coming up, they'll offer more. They may not take security, or you may not have to put your house on for a smaller business, or they're more flexible. And then you've got second tier lenders, and they do things like debtor finance, which the big banks used to do, but most have pulled out now, and products like that, which might be more attractive to certain types of businesses. So, for example, a debtor finance product will only take security over the debtors as opposed to a property or the shares of the company. So, different things like that just allow for flexibility and suit your personal or the business's needs.
Yeah,
but sure. I think one mistake that's often made is people will just go to their banking manager who they've been dealing with for X number of years, probably quite a while, and they've got a strong relationship, and they'll present, the banking manager will present the product that they think is best. But just coming back to your comment from your report just before there, they won't necessarily know the business that well, so they may not know the product that's best for the business. And banks being as big as they are, not everyone in the bank knows all the products that the bank can offer too. So it's important that you put yourself in the right area of the bank. And unfortunately, loyalty isn't always rewarded when it comes to banking. So you sticking with a bank for 20 years doesn't necessarily get you the best deal in all cases.
Sure. We've got some questions coming through, so keep them coming. Happy to pass these on. And the first question we've got is from Iris, who's asking about the publication I've been holding up. So the Purple Book, as you've called it, you can get a copy by downloading this for free on the AMGC website. The 10 Ways to Succeed in Australian Manufacturing. It's a brand new publication and free for all. Some great case studies in there and some examples around what it means to be in manufacturing today. And it's based on research that we've been doing over the last 18 months and engaging with a whole range of manufacturing companies and universities and the general public as well. So it's fresh and hot off the press, and download for free. Gary, Family Business Australia has grown over the last 20 odd years. And I know you're a former chairman of that organisation, but bringing people together and sharing experience around accessing capital and growing your business, those sort of things happen in the forum groups. And I think now what we're seeing through the crisis is the more that people can collaborate, share their experiences and grow from each other is really important. Could you tell us a bit more about FBA and how it's evolved over those times?
Yeah, thank you, Michael. Correct. We joined up in 1999, which was originally kicked off in 97. And the whole idea was that as family businesses, we didn't really have much say at the government level, and that the original starters wanted to form us and get us into a group where we got some numbers where the government started to listen to us. And it's only today.
We might have lost Gary there. I think he's frozen, but that's okay.
Challenges.
This is where we find ourselves in 2020. As soon as you come back, Gary, that's fine. But FBA, just Google Family Business Australia for those out there, and you can see that organisation, which has groups in each state, and it's been growing very fast. But certainly collaboration is a key driver, particularly for manufacturing. The more we can bring people together to share their experiences and how they're getting through this current crisis is important. And we can all learn and support each other to move on. Again, I talked about the Manufacturing Academy. I've got a flyer for that one here. You can see that. But again, a whole range of speakers that are sharing their experience around automation and robotics, market reach and exporting, how to compete on a global scale, a whole range of subjects there that you can learn about. So get involved with that.
Yeah, sorry, Michael, back again.
All good, Gary?
So the family business, from the corner store right through to the wine, our great wine companies, there is a great relationship and also a good communication to actually learn from each other, and especially when you're going through generational change in Australia. This is the time they say in Australia we're going through one of the biggest generational change at family business. The help that these guys and the people they can introduce you to has been absolutely fantastic, and also been a very integral part of the success of AHBID, going from the 3rd, 4th to 5th generation, and now planning for generations to come. So the word you used before, is very critical for everybody to know what it's all about and what we're trying to achieve as a manufacturer in Australia. We're in for the long run, and communicating that is the most important part when you have plants all across Australia.
Yep, absolutely. Nathan, how can a business leverage its working capital to access funding? Can you give any practical examples of how this could work?
Yeah, so just expanding, I think, a little on the debtor finance product that I touched on just before. It's quite big in the UK, and I think has been big in Australia historically, but it's certainly tapered away in recent years, and isn't anywhere near as prevalent as it was or is in the UK. But it allows you, in general terms, to get 80 to 85% of your invoice paid within, say, 24 to 48 hours these days. So, if you're a manufacturer and you're dealing with big business, say Woolworths or Coles or something like that, you may not be getting paid for 60 or 90 days. Sometimes they'll stretch you out, and they can have a massive crunch on small business. So to get that money in the door in 24 or 48 hours provides a massive boost to businesses, particularly small businesses. And then the remainder, less any fees, is paid in 60 or 90 days, or whatever the period is when that invoice is actually paid. Generally, securities is only over the debtors. So you're not, putting your factory up or your house up or the shares in your company up. So it's sometimes, a much more attractive option. At the same time, these second tier lenders, they'll prefer, obviously strong debtors. The stronger the debtor, the better. The less debtors to a degree, the better. They don't like kind of all the eggs in one basket, but, they also won't like if you're selling, $2 cans of Coke to 1 million people and waiting for 1 million lots of $2 to come in. So it can be an attractive option, and probably an underutilized option here in Australia. A recent example, I was working with a client of mine. They're in the alcohol space. They've been quite successful in the past, exited 2 businesses for many tens of millions of dollars, and started up a new business, and were looking to secure some debt funding for that business. They went down to their local bank branch. I won't say which bank, but one of the big 4 banks. Went down to their local branch who deals with their personal things, and said they needed a facility of around $1 million to get this business up and running. The bank manager there, the business bank manager, said, "No, sorry, it's a startup, no history, no assets. We can't help you." So they called up and they said, "What can you do?" So we called up the correct person at ANZ. This is a little off topic from working capital, but once you got it, the correct person at ANZ, they certainly could help, and they could certainly offer a facility that was attractive, and it just needed to be a little bit flexible in terms of maybe they had to use some security from outside the business, but there's certainly enough there to do something. But what they ended up going with was a debtor finance facility, selling their product into Woolworths and Coles. So they had a strong book of debtors, and the debtor finance company was willing to back them based on their past experience. So from the very first invoice this company issued, they were funded by the debtor finance facility, and that was based on their past experience. So, typically we say all debt lenders won't really like startup businesses, but that's where I'm saying these kind of newer neobanks and second tier can be a little bit more flexible, in that they'll look past the the specific business that we're talking about and look to the history. And if you've done it a couple of times before, then they're willing to rely on that history in the new venture potentially.
Mm. But again, you touched on, finding the right person. And I think that's just so important, is the networking, the collaboration. As a manufacturer, we're also busy in our businesses from day to day, but it's so important to get out there and talk to others, find those networks and build on the collaborative efforts, and that can really pay dividends, literally. So thank you for that, Nathan. I think the other thing to talk about is, when looking to access capital, is the vast array of government grants. And we heard the Minister talk about the new announcements from the federal budget last week, and the Manufacturing Modernisation Fund, round 2. That'll be coming up shortly. That's a $52 million fund for working capital for such things as buying plant and equipment for manufacturing. And so I would encourage you to have a look at that and Google the Modernisation Fund. Certainly look at the AMGC website. Again, feel free to join the Advanced Manufacturing Growth Centre. It's completely free to join. We've got over 3,000 member companies all around the nation, and it's growing day by day, which is just terrific. People are talking about manufacturing, which is the exciting part. There's another fund called the Recycling Modernisation Fund. That'll end up being around $1 billion fund for the circular economy. So looking at using recycled products in your supply chains. And if you're working on something towards that, feel free to reach out to myself. You can find me on the email or LinkedIn, but we can talk about the Recycling Modernisation Fund. That's already been announced, $190 million from the federal government, but it'll be matched with the various state governments across the country. So certainly a lot of work going on for the circular economy, and looking at such things as recycled plastics that you'd use in the manufacturing, but it can be much broader than that too. I know some of the food manufacturers that we deal with are looking at using recycled food waste to make food trays and things like that. So it becomes completely circular. So there's whole new opportunities out there. We're blessed in this country to have some of the greatest research minds in the world right here in Australia. They're locked up in these universities. So it's been a great privilege of mine to go around the country and meet with manufacturing companies and walk the factory floors and introduce some of these great researchers to look at new opportunities where you can grow your business with some new ideas and then get matched funding to put a research project together. And on the AMGC website, you can see some of those projects that we've co-funded. I'm thinking of projects like Dresden Vision, who've developed a plastic recycling waste stream to manufacture prescription eyewear. They're the only company in Australia that manufactures glasses, and they now have 9 stores across Australia, stores in New Zealand and Canada, a startup company that's going from strength to strength and very much involved with the circular economy. So there's ways to look at government grants for capital. I think more and more people need to look at how they can access that. And certainly at AMGC, we're happy to offer some guidance around accessing those various grants that are coming our way right now. We've got another question here, guys. So this one's from Evan, and there's been a lot of governmental push recently for advanced biomanufacturing. Does biomanufacturing fall under AMGC? It certainly does. So we have a whole range of manufacturers. Our foundation member was Thales, the global defence company, and they're looking to build local supply chains in defence. Right now, we have the largest defence budget in the nation's history. It's $270 billion for defence projects. And so manufacturing can certainly play a key role there, whether it's providing food products to the troops or big engineering projects like the submarine and naval shipbuilding projects that are going on. There's a big variety of projects that you can get involved with from the manufacturing side, and you can look at diversifying your business to get involved with projects like that. So thanks for the question, Evan. Keep them coming. Here's one for you, Gary. Gary, I'm interested to know how you manage roles held by family members who may or may not have the skills for an area. Example, lean manufacturing skills, and how others in and around show up, how others around them show up in such a circumstance. I guess it's talking about generations, and what's the experience you've seen in Family Business Australia, and how do you work the generations coming through?
One of the things we worked towards with the learnings from FBA was as an example with my own family, 4 children, that to get them outside of the business and go and work for another boss, in inverted commas, and where possible, get a skill that they chose themselves. And then after that, if they want to join the business, by all means do. And the transition of time is that in order to keep up with manufacturing at the pace it moves internationally, we have gone to the market and found the best in the game. And so what is happening with our 5th generation, they're able to work alongside what we consider the best and most knowledgeable people in the game that travel the world to find the best practices. The lean manufacturing and just in time was my little baby back in the 80s, whereby the threat of the imports meant that we had to be a much more efficient manufacturer. We'd live on a 3 to 4 weeks delivery time back in those days. Today, except for COVID and the extra business we got, we work on a basis of order today, make tomorrow, and deliver the next day across the whole of Australia. That's why we do have plants in every capital city of Australia. And so that does keep us in a good position with our retail partners. Rather than them buying a box of beds from China, we can provide them a bed within a week, I suppose, would be the maximum that we work to. And in answer to the gentleman's question, yeah, the training of our next generation is very important, but also to be able to work alongside people that are much better than brother and myself on modern day practices, and that they certainly get the advantage there of working with them, and also in the industry, learning how everybody is growing together to provide what we consider is the best bed we can make for the Australian market.
Yep. Good one. Thanks for that, Gary. Nathan, private equity. A lot of people ring us and ask about investments to their business and looking for access to capital, exactly what we're talking about. But with private equity and family offices, there's alternative sources of capital there. What's their typical investment criteria? What are they looking for?
Private equity can be a scary term to some people. It maybe doesn't have the best reputation in certain countries or certain deals or things like that. There's probably different levels of private equity is the best way to put it. You've got your big end of town who you'll hear about in the news, and they'll be doing deals that are, hundreds of millions of dollars or billions of dollars, taking Bain taking Virgin private and the big end of town like that. The funds that we deal with typically focus on the small to mid market. So I think you'll find there's quite a few manufacturing businesses that will fit into that small to mid market. And they typically work off an EBITDA threshold. So you'll find funds that invest anywhere, if the business is making anywhere from $1 million at the EBITDA level to, say, it's kicking in around $3.5 million of EBITDA, things like that. They often look at minimum check size as well. So they won't some went into discussions for a check size of less than, say, 20, 25 million. But again, there are smaller funds. We're working with one at the moment who'll do a deal that's, probably in the region of $2 million. Generally, they like to take a controlling interest in a company. There are funds that will take a minority interest. They won't take 100% interest unless it's a bolt-on acquisition to another business that they already own. So they like to partner with existing management. Most of them will kind of sell themselves as a growth partner. So if you're an Australian manufacturing business and you want to expand overseas, but don't have the resources, financial or otherwise, you can leverage a partner to tap into those markets. Or if you want to if there's an acquisition that you're looking at in the current market, in the Australian market maybe, but you need a way to fund that acquisition, maybe they're a partner for that. They'd like you to have a strong market position or a competitive advantage. So, you know, they won't necessarily, or it's unlikely they'll invest if there's multiple businesses doing the same thing and you can't really differentiate yourself from the next person. So you need to kind of stand out from the crowd a little bit is probably a good way to put it. But they're flexible. They're becoming more and more flexible.
I was going to ask you on that, Nathan, is in your experience at private equity deals like you're describing, is there opportunity for business owners to take money off the table? Or is every deal completely different?
So, certainly every deal is different, but they like to partner and they understand if someone's built a business from scratch, then you want to take some money off the table. That would be in the majority of their deals. So if they were coming in for, let's say, a 60% investment or something, and you retain 40, you'd be taking a good chunk of that 60 off the table. And then if they had to put a working capital facility or something into the company, then maybe they do that separately. But taking money off the table would generally be in more deals than not.
And how long does that sort of process take in your experience? What's a typical
investment process?
Yeah, what's a typical time frame for a private equity group to reach out and talk to potentially a family business, say? And are we talking months or years?
I've seen both. Again, you know, if you're actively looking for an investor and you've got a bit of competition, then you can get them to move pretty quickly. And we're talking months, maybe 2 or 3 months. But they certainly have been known to court businesses for years. And, you know, and maybe it's because they like a sector, they like your business for whatever reason, but you don't quite tick some of the thresholds that they have. Maybe your EBITDA is not quite there yet or something, or they just want to, you know, maybe it's quite a new sector, but a hot sector, and they want to just see how it plays out a little before they pick a winner. They'll hang around, they'll talk to you. In some cases, they might, you know, help you a little bit almost for free with a view to kind of getting that inside running down the track when you are looking to take on an investor.
So how important then is it to get your business prepared for that sort of scenario?
Super important. You know, ideally, we'd like to work with a company probably at least a couple of years in advance of taking on an investor, if at all possible, just to kind of get things in order, you know, get the mindset right, get the financials looking nice. Often private businesses are kind of run for the owners. So there's discretionary expenses in there. There's maybe family members in there getting paid who don't work, things like that. Just tidying up the numbers. And it's a different mindset too. You know, if you're a family business and you suddenly take on a 60% majority partner, you don't have anywhere near the level of say and control that you had in the past. So it's a completely different mindset and a transition. And, you know, you've got a board to report to every month, which you might not have before. And you've got management accounts to kind of, that you get looked at and get assessed against. So it's a different mindset, and it takes a while to get people's head around that in some instances.
Yeah. And Gary, I know in your business, you've had to invest over the generations with new equipment, going from one factory to multiple factories around the country. So that's significant investments. And I'm sure we can look at some government grants that might support your future works, and looking at the robotics and automation. That's certainly a discussion that we can have. But, you know, last week we had a bit of a catch up and you talked about the Oldsmobile, and I thought you might just share us a bit of story about the Oldsmobile, mate.
Well, that followed on like being flexible and adjusting. My grandfather during the Depression had the ability to get the contract for the hospital, so he'd go around and collect all the mattresses that were full of horsehair back in those days, bring it back to the factory, organise the boiling system, so we'd boil it all and then recurl it, as they actually refer to it, and then put it back into a mattress and take it back to the hospitals. But the Oldsmobile you're referring to was a 1935 model Oldsmobile, which after the Depression there was shortage of power, there were brownouts, so what they used to do in the morning, they'd take the wheels off the back of the truck and hook it up to a generator that Papa bought, and they'd run the power for the factory, and then in the afternoon put the wheels back on and go and deliver what they made. So yeah, being flexible, it's a great trait of an Aussie that when the pressure's on, you do what has to be done.
Well, that certainly is capital investment into plant and equipment, though, the old Oldsmobile, and I believe it's still around, which is great.
It's not the actual truck, it's one I found down in Melbourne, so I restored it the same as what that one. It was a pride and joy, but the 27 Chev, we have the 1927 Chev and the 1935 Oldsmobile were certainly the pride and joy of both my grandfather and dad. And I suppose one of the traits of being a beard is having a truck license.
That's fantastic. We've got another question, guys. So Nathan, this one is, I'm interested in your compliance with covenant experiences when it comes to debt raising versus reporting requirements when it comes to equity or capital raising through investment rather than debt. Would you like to tackle that one?
Yeah, I'm just trying to understand where they're coming from. Interesting compliance covenant. So I think I don't know that there's going to be I can't think of a difference in reporting requirements towards covenants and equity investors.
Well, I guess what that leads to, Nathan, really though, is how important is it to engage people like yourself? You know, what value is there to a company retaining an advisor like RSM when they're looking to access additional capital? You know, I guess that's what it's leading to, isn't it? It's saying, you know, get all your ducks in a row, be prepared, because you never know who might approach your business looking for that bolt-on acquisition, perhaps.
If I can jump in there, Michael, one
Yeah.
thing I've found is very, very good with these people like Nathan is you get to understand what the other person sitting on the desk is thinking and how they look at your numbers.
Okay.
So if you can get your numbers in the right frame that they understand what they're looking at and you understand what they're looking at, puts you in a much more stronger position to ask for money. Is that sort of where you come from, Nathan, of getting both parties, like more so the people with the money and the person who wants the money to understand what they're both looking at?
Yeah, I think that's a good point. And I think it's the same person here who's just made another comment, which is more or less onerous and challenging to cope with. I find both relatively flexible. You know, a bank, it's a hassle for a bank to go and kind of enforce covenant breaches and then, you know, recovery action and all of that kind of thing. If you've tripped up a covenant, and I find if you're on the front foot and you've got a good reason for it and, you know, the problem's been rectified, then the bank will hopefully more often than not see through that and maybe either adjust the covenants or allow that breach. Same with equity. You know, equity investors put themselves in the business and actively in the business, so they understand the business. So, you know, hopefully there's no shocks in the financials to them when they see them. But, you know, as long as there's an explanation for it or a specific issue, you know, COVID-19 or something, I've just found kind of the more on the front foot you can be and upfront with people, whether they're equity investors or debt providers, the better the outcome's going to be. So kind of let's not hide the covenant breach and then try and fiddle around with the year-end accounts to just get yourself over that covenant. Let's just reach out to the bank and say, hey guys, you know, we've tripped it up because of X. What can we do to fix that situation? So hopefully that answers the question. And then Gary, back to your point, I think you were spot on with what you were saying there. I think it's twofold. We know what our debt providers and equity investors are looking for, so we can help you to prepare for that. You know, I just finished the due diligence today for one of the big four banks on a lend they're looking to do to a business in Melbourne. So I've kind of done that report on behalf of the bank. And you know, tomorrow I could be helping a business go to that same bank to try and raise debt. So I think we certainly have a good understanding of what these people are looking for. We have a good understanding of the different products that they have and who to contact to get access to those products. So as I touched on before, I think one mistake or a mistake that people make is going to their bank, you know, manager or relationship manager that they've had for kind of 5 or 10 years and asking for I need a product to do this, and they'll give you a product and kind of moving on. So I think that's good. The preparation is certainly one side of it, and just the products and the access to different contexts. So, you know, you may have a contact at your local bank, but not in the corporate branch in the city, or, you know, you may not have one private equity might have approached you, and then we know 3 more who are looking at that sector. If one private equity firm's sniffing around a particular sector, you'll often find some others are. So it's insights like that we can give, and we're happy to have conversations and share those insights.
I think that's really important, and it can be reassuring for business owners to get that guidance and that advice. But as I mentioned earlier, to collaborate and reach out to others in the same boat is important too. So look to get involved with your local manufacturing networks. And again, you can reach out to AMGC and we can offer you some guidance around those sort of networks that are available. But Gary, I just wanted to talk about the COVID crisis that we've been through, because it was so important to have your national footprint of factories. Because one of the things we had going in the early weeks, and I'm going back to the early weeks of March when it first happened, was being able to have that national capability, because there was a chance back then that the states might close down individually. And who would have thought, but it eventually did happen. And so to have emergency hospital beds, which were envisaged, we needed to have a national footprint to be able to look at all those scenarios. So that was really important. I'm grateful for your support during that time. What we've been able to do in the meantime is set up the National COVID Response Register. So for any of you out there that are looking for any medical PPE, any safety equipment, you can go to the AMGC website. Again, it's free, but you'll be connected to a whole range of manufacturers right across Australia that are making that sort of face mask, hand sanitizer, even emergency hospital beds. So have a look at that and get involved. But I'm really grateful for our panel speakers today. We've got a lot more to come. We've got more seminars coming up, which you can register on our website. We'll be spreading the news on our LinkedIn and Twitter feed. So feel free to join me and the speakers on LinkedIn, connect with us. And I know that Gary's happy to share information and offer support. So I want to thank you both for joining me today and look forward to catching up in a couple of weeks. All the best.
Thank you, Michael.
Thanks for having me, Michael.
Bye now.
Cheers.